Good morning everyone, and welcome. Today, we'll be diving into comprehensive strategies for detecting financial statement fraud. Our focus will be on understanding and identifying manipulations in revenue and inventory by exploring analytical, behavioral, and investigative methods. I'm excited to share insights that will help us better recognize and address these critical issues. Let's get started. Financial statement fraud is essentially the intentional distortion or falsification of a company's financial reports with the aim of misleading those who rely on this information. This kind of fraud often targets specific areas, particularly revenue and inventory accounts, because manipulating these can significantly alter reported earnings and asset values. Such distortions can mislead investors, creditors, and other stakeholders, leading to poor decision-making. The main goals behind financial statement fraud usually include making the company appear more profitable or valuable, which can help secure financing, artificially lift the stock price, or meet certain financial goals. That's why it's so important to understand how these manipulations occur, to help us detect fraud early and prevent the spread of inaccurate financial information. Let's talk about some common revenue-related fraud schemes that companies might use to manipulate their financial results. First, there's overstating sales transactions, which means recording sales that never actually happened. This inflates the revenue numbers without any real business activity behind them. Next, creating fictitious sales takes this a step further by generating entirely fake sales records to make the revenue look higher than it truly is. Lastly, premature revenue recognition is when a company records income before they've fully earned it or delivered the product or service. This can give a misleading impression of financial health. All these tactics distort the reported revenues and profits, misrepresenting the company's actual performance and potentially misleading investors and lenders who rely on these financial statements to make decisions. It's crucial to be aware of these schemes to understand the reliability of reported financial data. Let's look at some common inventory-related fraud schemes. First, inflating inventory quantities means reporting stock that doesn't actually exist. This can make the company appear more valuable than it really is. Next, overvaluing inventory involves using improper methods to assign higher costs to inventory items, which inflates asset values. Another tactic is concealing obsolete or damaged items. Instead of writing these off or removing them, they're hidden to avoid recognizing losses. All of these practices distort financial reporting by overstating assets and understating expenses, which can seriously mislead anyone relying on the financial statements to assess the company's true health. When searching for fraud through financial statement analysis, there are a few key methods to keep in mind. First, ratio analysis is a valuable tool. By looking at metrics like gross profit margin or inventory turnover, we can spot unusual fluctuations that may signal potential issues. Next, trend analysis involves comparing data from current periods to previous ones, helping us identify any unexpected patterns or anomalies that don't quite add up. However, it's important to recognize the limitations of these methods. While they're great for highlighting red flags, sophisticated fraud schemes or deliberate accounting adjustments can sometimes evade detection. That means we need to interpret these analytical results carefully and consider them as part of a broader investigation strategy. When we talk about searching for fraud through non-financial asset assessment, one key method is the physical verification of inventory. This means actually checking the quantities and condition of the inventory on hand to ensure it matches what's reported in the financial records. Another important approach is reviewing operational indicators, such as production levels, customer orders, and shipping data. By analyzing these metrics, we can spot inconsistencies that might suggest something isn't quite right. The main purpose of these non-financial assessments is to corroborate the financial information. If there's a mismatch between what the records say and what we observe in real-world assets or operations, it serves as a strong red flag for potential fraud. This cross-check adds an extra layer of validation that helps uncover hidden issues. When it comes to detecting fraud, paying attention to behavioral cues can be very telling. For instance, signs like nervousness, evasiveness, or defensiveness from employees or management can raise red flags. These behaviors might suggest someone is uncomfortable or hiding something. On the verbal side, Inconsistencies or contradictions in how financial results or transactions are explained are also important indicators. If the story keeps changing or doesn't add up logically, that's a strong signal to look deeper. However, it's important to remember that these behavioral and verbal symptoms on their own don't prove fraud. They need to be considered alongside other evidence. When combined, though, they can provide a compelling reason to conduct a more thorough investigation. Anonymous tips play a crucial role in uncovering fraud that might otherwise go unnoticed by routine audits. Often, whistleblowers provide information that reveals hidden or ongoing schemes, giving investigators a critical starting point. These tips can also offer specific leads that help guide the investigation or support existing suspicions, adding valuable context and detail. However, it's important to remember that not every tip will be accurate. Validating these claims through thorough investigation is essential to avoid diverting resources toward false accusations or misunderstandings. This careful approach ensures that efforts are focused where they truly matter. To confirm potential fraud, the first step is to perform detailed transaction testing. This means closely examining the sales or inventory records to ensure that every entry is genuine and properly documented. We want to catch any discrepancies or unusual patterns that might indicate falsification. Next, we move on to obtaining third-party confirmations. This involves reaching out directly to suppliers or customers to verify that the transactions actually occurred as recorded. Third-party validation provides an independent check and strengthens the reliability of the information. Finally, conducting employee interviews is crucial. Speaking with staff members can provide valuable context, uncover inconsistencies, and help clarify any suspicious findings. Employees often hold insights that are not immediately visible in the data, so their input is a key part of the follow-up process. When we look at the benefits and limitations of different detection methods, it's important to understand how each approach contributes and where they might fall short. First, structured financial analysis provides a clear, quantitative way to evaluate financial data. However, it's not foolproof because clever accounting manipulations can sometimes mask problems. Next, reality checks through non-financial assessments help verify the tangible assets or operations behind the numbers, but these methods can be time-consuming and require significant resources. Then, behavioral and verbal symptom detection offers valuable qualitative insights by observing how people act or communicate, but it's inherently subjective and can't definitively prove fraud on its own. Anonymous tips can be a powerful tool to uncover hidden issues that might otherwise go unnoticed, though it's crucial to carefully validate these leads before taking action. Ultimately, no single method is perfect, so combining multiple complementary approaches helps improve detection accuracy and minimizes the weaknesses of each individual method. To effectively combat fraud, it's crucial to use a combined approach. This means integrating financial analysis, asset verification, behavioral observations, and evaluating tips. No single method is enough on its own, so combining these techniques gives a more complete picture. It's also important to stay alert for common revenue and inventory fraud schemes. Understanding the typical signs and indicators helps us recognize when something might be amiss. When you spot initial red flags, never ignore them. Follow up with thorough investigative procedures to dig deeper and confirm whether fraud is occurring. Lastly, always maintain professional skepticism. Keep questioning and verifying, and stay informed about new and emerging fraud trends. This ongoing vigilance and education strengthen our ability as auditors and financial professionals to detect and prevent manipulation in financial statements.